Good morning. This is Jeffrey Christian, CPM Group. Welcome to the briefing for CPM Group's Silver Yearbook 2020. Glad that you all were able to join us, even if remotely. We've actually been doing these things remotely for several years already. So the COVID virus is only a minor nuisance to us. I think I finally learned how these joint conferences are to go. I will speak a little bit and then I'll pass the baton to Rohit Savant, who's our VP and head of research and the primary author of the Silver Yearbook, as well as a lot of our other precious metals research. And he'll go through a lot of the granular details. And, you know, studying the way joint webinars go, I now understand I'm supposed to say some things somewhat abusive, maybe profane, throw out a lot of misinformation, and then Rohit will spend the rest of the webinar correcting my errors. But seriously, one of the reasons why we have always done the Silver Yearbook, and these reports go back to the 1970s when we were at the J. Aaron Research Department, is that the silver market is sparsely populated with information and statistics and data. For many years, we were the only source for basic data on supply and demand in silver. And even now, as the market has developed and changed in recent years, we find that there's a tremendous amount of misinformation and bad data and inaccurate statistics and wild misunderstandings, not only in the silver market, but also in other markets. We've seen this in gold this year, platinum and palladium, which are our specialties, but also in the oil market, copper market, and some of the agricultural markets that we work in as well. So the Silver Yearbook has always been a source of primary data that's accurate, unbiased, and helps to understand and explain why the silver price has done what it's done in recent years. As always, we need to thank our sponsors and partners. Our China partner is the Shanghai Huatong Silver Exchange, which is the primary physical silver exchange in China. They translate and distribute our silver reports in that country. We also have a number of sponsors, and we work very hard to spread our sponsorship across the industry. So we have several major producers and developers of silver mines: Endeavour Silver, Metallic Minerals, Pan American Silver, and Silvercorp. But we also have the Institute of Scrap Recycling Industries, Sabin Metal Corp as major refiners of silver from scrap. And then we have Kitco Metals, which is also a refiner as well as a supplier of precious metals to the industry, and Monex, which is for decades was and probably still is the largest provider of silver investment products in the United States. So we have producers and consumers and refiners as well as exchanges as our sponsors. And that helps us maintain our objectivity and unbiased posture. I want to talk a little bit about the silver price. This chart shows you how it spiked higher, got up to almost $50 on an intraday basis in April of 2011, came down, sort of reached a plateau in 2012, fell sharply from 2013 through 2015, and has been moving sideways for about 5 years. You can see that the price has been trading really between about $13 and $20 for most of the time, and actually for most of the time between, say, $15, $16 and $18 or $19. It got lower in 2018 and 2019 as we saw investors buying less physical silver than they had at any point prior to 2005 or since 2005. You saw a tremendous lack of demand for physical silver, and Rohit will talk a lot about that because that's a primary mover for longer term silver prices. The price started to rise in late June of last year. We'll talk about that. And it rose sharply, got up almost to $20 in the course of July and August. It peaked on September 5th. A lot of that had to do with futures and options and forwards and ETF, leveraged ETF investments. The price then fell into late December. It began rising again in early January as various economic and political problems started to come to the fore. It continued to stay at those higher levels around $18, $19 an ounce as the COVID-19 pandemic broke out. When we had a liquidity crunch across financial assets, and when we had an increase in margins and collateralization requirements for people who had leveraged accounts, we saw a price spike down quickly. It came back just as quickly, and it is now basically trading around the levels that we saw from late 2018 into the middle part of 2019. Our discussion today hopefully will explain why the price has behaved that way. Now, if you go back to early June 2019, before the price started rising, this is a chart that we use in our monthly precious metals advisory. And we basically look at events, macroeconomic, political, financial market stability issues, and fundamentals of the market. And we say, what are these factors? How important are they to the gold price and to the silver price? What's their probability of becoming more important on an immediate basis in the next 6 months? And what is the likely impact? And we have been following these bubbles for some time, for years, and they've gotten larger and they've moved to the right, which means that their impact will be greater on gold and silver, but they haven't necessarily risen up until June 2019. So this is where we were before the prices started rising. This is where we are most recently. And you can see that the bubbles have gotten larger. There are new bubbles that didn't exist before, including the viral outbreak, and they've risen to the top. So that period of time in 2018, 2019, when investors were buying less silver and gold, those risks were growing, but they were on the distant horizon. That horizon is now upon us, and they've gotten bigger, and there are new risks that have come along and joined them. You can take that and you can look at our expectations for global economic performance over the next 10 years, and you can interpret those bubbles into this. In January, we were projecting that we would see somewhat slower real growth in 2020, but not a recession necessarily, and a deeper recession that would appear around 2023, 2025. If you go forward now, we're looking at a very deep recession in 2020 into 2021, a recovery, and then another recession still in 23, 25. Our economic projections are keyed off of the economic projections of the World Bank and the IMF. Last Tuesday, the IMF came out with its revised economic projections, and they were projecting this 6% decline in the industrialized world's GDP this year, with a 4% plus recovery in 2011. They were projecting negative 3% growth in global economic activity this year, which is the deepest decline in a one-year period since 1929, 1933, the start of the Great Depression, followed by a recovery to about 5.8% next year. We think that they probably have underestimated the depth and length of the recession. And our own view, which is not necessarily reflected in this, but we use their view for 2020, 2021. Our view is that you will see the recessionary conditions probably linger longer than a lot of people thought, There is a tremendous amount of fiscal and monetary stimuli that are coming into the US and European and Japanese and Chinese markets that will be reflected in some stronger growth in the third quarter, just before the US election. And we do think that you'll see a recovery in 2021, but the recovery also may be more muted and more delayed than the IMF thought. Beyond 2021, we're relying on our own projections, and we still have a large recession, because even when we get beyond the current situation with the COVID-19 virus and the global lockdown on the economy, all of those bubbles will still be there, and they'll still be in that upper right-hand corner. And they're probably going to stimulate a revival in investor demand for physical silver and gold, as well as futures and options and ETFs. And that will probably be reflected in stronger demand and higher prices later, because those problems are not going away anytime soon. My last chart before I pass the baton over to Rohit has to do with silver bullion inventories. And these are the statistics that we have. You can see that from the 1970s, when we were the J. Aaron Research Department, through the 80s and 90s, we had an enormous amount of implied unreported stocks. In the 1990s, a large amount of that metal was used in a 15-year period where we had a supply-demand deficit. And when you look at a supply-demand deficit, you have to use Commodities Research 101. Supply is total supply, mine production plus scrap, and demand is fabrication demand. You exclude investment demand, including coins and bars and ETFs. And you look at the supply-demand balance of supply, total supply less fabrication demand, because that's what you want to know. You want to know, is this market tight? Is it in a surplus or a deficit, without investors coming in and skewing the bottom line? If you have a market that is in a deficit without investment, without adding investment demand to your supply-demand balance, then you've got a very bullish market. If you've got a market that's in a surplus, that's telling you that investors probably are bidding the price up and buying and stimulating lower fabrication demand and higher supply, especially from scrap. And you see that. So from 1990 through 2005, we saw a massive amount of metal used from these inventories. After 2005, you had the advent of ETFs, and some of that remaining metal that was in unreported investor stocks actually was transferred from 1,000-ounce bars that investors held and other forms of silver into ETFs, because the ETFs were a more efficient way to buy, own, and sell silver in the minds of many investors. Now, in the last 18 months or so, the London banks have begun reporting inventories. Actually, I guess it goes back a few years. And we're looking at how we bring that into our data, as well as how we bring in other unreported stocks in other places. But you can see that there was a shift away from unreported inventories into reported inventories, and this is the best data that's available right now. We continue to research the market as we have since the 70s, and we'll continue to look for ways to improve upon this. I'm going to pass the baton over to Rohit Savat now and let him take over the presentation at this point. Rohit?
Thank you, Jeff. So I'm going to start here by talking about investment demand for silver. Silver investment demand stood at about 36 million ounces in 2019, which, while higher than what we had in 2018 at about 27 million ounces, was still the lowest level of investment demand that was seen since 2006. And then when you compare what we saw in 2019 to levels seen in 2012, when investment demand was about 197 million ounces, 2019's investment demand was in fact 82% lower than those levels. So this declining and low level of investment demand in recent years helps to explain to a very large extent silver's lackluster price performance that we've been seeing. What we have seen in recent years is a pulling back of purchases by longer term investors of coins and bars. These investors have pulled back to a large extent because they've been disillusioned by silver's inability to maintain price rallies both in 2011 and then again in 2016. That said, on the whole, investors have remained net buyers of silver, unlike during the 1990s and early 2000s when they were in fact net sellers of the metal. It's really short-term tactical investors that have dominated silver investment demand and prices in recent years, buying when prices decline and selling the metal when prices rise. And this helps to explain to a large extent what has kept silver prices in this narrow trading range since around 2014. We expect silver investors to continue buying the price declines. However, they're expected to be less aggressive sellers when prices rise, which we believe will help to increase net investment demand during 2020. Silver investors are expected to be cautiously optimistic about the metal during 2020. We do not expect a surge in demand to levels that we saw even earlier in this decade. But silver investment demand is forecast to rise and reach about 79 million ounces in the current year, which would be the highest level of net investment demand since 2016. So one of the reasons why investors are likely to be less aggressive in selling silver is the deep discount of the metal to gold. Silver prices at present are being influenced most strongly, in our opinion, by the metal's fabrication demand fundamentals. It's not uncommon for silver's price gains to lag those of gold, and this is something that has been observed multiple times on previous occasions. Investment demand for silver is primarily influenced by the same factors that affect gold. However, this doesn't seem to be happening at present. But the immense amount of liquidity that we've seen pumped into the market by central banks, this coupled with when we have a confirmation that economic growth has bottomed out, I think we can expect to see silver prices rise in that environment. So essentially a combination of liquidity and certainty about economic growth will help to boost silver prices, in our opinion. This is based on our expectation that central banks and governments will not reverse any of the liquidity that they've added in recent weeks, at least for some time after the economies around the world begin to recover. We do not see a sharp increase in silver prices in the short term, but have a positive outlook for silver prices in the medium to longer term. Now heading into the more specifics sectors within investment demand, what we're looking at here is global silver coin demand, which stood at about 79.7 million ounces in 2019. It was up from 78.8 million ounces in 2018. And much of that gain was driven by growth in sales at the Perth Mint. You did see marginal gains and losses at other mints, but the primary driver of that increase last year was increased sales from the Perth Mint. Silver coin demand is forecast to rise in 2020 and expected to reach around 86.8 million ounces this year. But when you look back historically, this is still lower than levels that were seen between 2010 and 2016. So what we're looking at here in the chart on the left-hand side is the sales of US Mint Silver Eagle coins. And in 2019, these had slipped to the lowest level since 2007. During the first quarter of this year, sales have exceeded those seen during the corresponding period in 2019, but much of that gain occurred during the second half of March, following the sharp decline in silver prices in the middle of the month. As can be seen on the chart on the right-hand side, premia paid by dealers for these coins rose sharply during this period. And this was in part due to an uptick in the demand from investors and in part due to the low levels of inventory that was being held by dealers. Demand for these coins have fallen back in April, with total sales at the end of last week standing at about 350,000 ounces, which compares to 5.5 million ounces in sales during March. So this is in line with our expectation that investors would be, are cautiously optimistic and are more likely to be aggressive buyers when prices decline sharply. Silver ETF holdings have a slightly more positive story. Silver ETF investors added about 85 million ounces on a net basis to their holdings in 2019. Investors had added record monthly volumes of silver to their holdings in the middle of 2019, but sold back some of that metal during the last quarter of the year when prices rose. These investors have continued to add metal to their holdings this year, and it actually reached a new record high of 821.3 million ounces on the 17th of April. And at the end of last week, net additions to ETFs for 2020 stood at about 78 million ounces. So pretty close to what we had for the entire year last year. So these investors, again, have been using price declines to continue adding to their holdings and seem less likely to sell large volumes when prices rise. So they've been holding on to the metal more tightly than what we've seen with some of the other investors. So what we're looking at here is gross long and gross short positions held by institutional investors on the Comex. And while the frequency has reduced, net long positions held by institutional investors had continued to decline into negative territory even during 2019, after dipping repeatedly into these levels during 2018. Net positions held by institutional investors slipped into negative territory during May last year, ending the month net short 130 million ounces, down from net longs of 840,000 ounces at the end of April. Net long positions held by institutional investors rose back into positive territory starting the middle of June 2019, which is when you started seeing that generally positive investor sentiment towards the precious metals, and remained there for the remainder of 2019. Net long positions by the end of the year were up to about 360 million ounces. That positive sentiment remained in place until the middle of February 2020, with net long positions rising all the way up to 403 million ounces. These positions declined between the middle of February and the end of March to 141 million ounces, driven lower primarily by a decline in gross long positions. So what we've seen with these investors is that they've tended to be a lot more in and out of the market, which has been one of the primary factors that has both weighed on the price and increased price volatility in recent months. So with that, let's shift gears to fabrication demand. Silver fabrication demand declined for the first time in 6 years during 2019, slipping to 926.4 million ounces, which was down from 928 million ounces in 2018. There was an escalation in trade wars between the US and many of its major trading partners, especially China, which weighed on business sentiment and global economic growth, and which eventually ended up having a negative impact on silver fabrication demand during the year. Silver fabrication demand declined in almost all of its uses, with the only notable exception being ethylene oxide catalyst demand, which rose during the year. Silver fabrication demand is forecast to decline during 2020, driven primarily by the disruptions to supply chains and decline in demand due to the negative economic fallout from the containment efforts of the coronavirus. Lost production due to factory closures and supply chain disruptions during the first half of this year are likely to, in our opinion, be followed up with a slow recovery in final demand from consumers during the second half of the year. And based on these expectations, we think that silver demand is forecast to decline to about 859 million ounces in 2020, which would be down around 7.3% from 2019. Now, if this level of demand is realized, it would make silver fabrication demand the lowest since 2014's 853 million ounces. There could be more positive scenarios which would be more supportive of higher demand, or negative scenarios that are worse for fabrication demand. And there's still a fair bit of uncertainty and a lack of clarity related to how strong final demand will be following the lifting of lockdowns in various countries. Consumers and businesses are likely to curb their expenditures for several months following the lifting of the lockdowns. There also will remain a threat of the second wave of infections from the virus following the lifting of lockdowns, which could be another factor which could weigh on fabrication demand. Silver electronics demand stood at 230 million ounces in 2019, which was down about 3.7 million ounces from 2018. The weakness in demand from the electronic sector can be attributed to softness in demand in electronic devices like phones and tablets, weakness in demand from the auto sector, and an excessive buildup in semiconductor inventory at the end of 2018, which was being worked through during the first half of 2019. So one of the areas that did see an uptick in demand during 2019 was the PC market. This sector got a boost after several years of declining demand, primarily because Microsoft ended its support for Windows 7. So that kind of resulted in a lot of new PCs being bought. And a boost to PC demand is typically good for metal demand because of the relatively higher metal content in these devices compared to other personal electronic devices. Another demand supportive factor has been the sharp increase in palladium prices over the past several years, which accelerated the substitution of that metal, at least partially, with silver. Despite these positive factors, which were supportive of silver electronics demand last year, they were not sufficient to offset the negatives, which resulted in that decline during 2019. Silver demand from electronics is expected to weaken during 2020, in large part due to the coronavirus-related supply chain disruptions and demand disruptions. And we expect silver demand from electronics to slip to about 225 million ounces in 2020, which would be a decline of 2.5% from 2019. So one of the main areas, as mentioned before, which hurt electronics demand was the reduction in silver demand from the auto sector. Over the past several years, the auto sector has become an important consumer of silver with increased electrification of vehicles. And while this trend has increased, electrification is expected to continue in the future. Strength or weakness in vehicle demand has a strong impact or stronger impact on the amount of silver consumed by this sector. So weakness in vehicle demand across major markets in 2019 weighed heavily on silver demand from the sector, and silver demand from the auto sector fell to about 39 million ounces in 2019, which was a decline of 5% from 2018. We forecast demand to continue declining in 2020 and slipping to about 37 million ounces this year. This again is based on the expectation of reduced car demand in a lot of the major markets across the world. So moving on then to demand from solar panels. Silver demand from the solar panel industry declined during 2019 to 97.4 million ounces, which was a decline of about 2.5%. The decline last year was driven by weak growth in panel production and an ongoing thrifting of silver use in panels. Demand is forecast to continue declining in 2020, slipping to about 78.8 million ounces. And this year's demand is expected to decline, driven by coronavirus-related factory closures and delays and temporary suspensions in project completions due to the virus-related lockdowns. The thrifting of silver for solar panels, which has been around for some time now, is expected to remain an ongoing theme and headwind for silver demand from this sector this year as well as in the future. In the medium to long term, the growth in demand for solar panels is expected to offset any losses in demand due to thrifting, resulting in a net increase in demand from silver from this sector. We anticipate ongoing growth in demand for solar panels in the future because of lower panel prices, increased focus of governments, businesses, and investors on creating a net zero emission environment, and the use of solar power to produce green hydrogen. So silver jewelry demand last year declined to 304 million ounces, which was a decline of about 1% from 2018. Last year's decline was in jewelry was driven by relatively slow economic growth and higher silver prices during the second half of the year. Now, while silver prices rose in the second half of 2019, the gains in silver were relatively lackluster compared to gold and palladium, which are also used for making jewelry alloys. So this helped silver demand from this sector, but not sufficiently to push annual demand higher. Jewelry demand is forecast to decline in 2020, slipping to about 279 million ounces this year. Lockdowns again across various countries have deemed jewelry sectors non-essential, around the jewelry stores as non-essential businesses. And even when lockdowns are lifted, consumers are very unlikely to be spending on jewelry purchases immediately. So all of this collectively we expect will weigh on jewelry demand this year. So with that, let's talk about supply. Total silver supply stood at 963 million ounces in 2019, which was up 0.8% from 2018, but still lower than the 1.02 billion ounces of total silver supply in 2016. So this total silver supply is primarily made up of mine supply and scrap supply or secondary supply. The relative weakness in total supply that we have been seeing in recent years can be attributed to weakness in mine supply, which has been hurt by multiple factors. So we've seen prolonged weakness in silver prices, a lack of new projects in the pipeline, and a shuttering and or suspension of various silver operations in recent years. Total silver supply is forecast to slip further in 2020 to 938.6 million ounces. Government mandated mine closures in various mining countries like Mexico, Peru, and China, coupled with voluntary closures at some operations, is expected to hurt total mine supply, which we are forecasting will slip to 735 million ounces, which would be the lowest level of mine supply since 2012, when total mine supply stood at 720 million ounces. So even without the coronavirus situation, global silver mine supply was forecast to decline during 2020, with Argentina, Bolivia, Peru, and Australia all contributing to the anticipated decline. Mexico's mine supply was in fact expected to rise during 2020, but now will be declining due to the government closures. Total scrap supply has been fairly flat at about 202 million ounces over the past few years. There have been various offsetting factors that have kept silver scrap supply flat. You've got greater regulation around e-scrap, which has resulted in more recovery from this source. Meanwhile, relatively weaker silver prices and relatively healthy economic conditions have prevented large volumes of jewelry scrap from entering the market. What you're looking at here is a new mine capacity for silver that came on stream in the past few years. This capacity has been in a declining trend since 2013, when it stood at 35.4 million ounces. Back then it was that high because it was responding to strong metal prices, not only for silver, but also for gold and base metals, of which silver is a byproduct. So in response to those higher prices, you did see a increase in new mine capacity back in 2013. However, when you look back at 2019, that new capacity had slipped all the way back down to 6 million ounces. So the lackluster metal prices that we've been seeing across the board over the past several years is responsible for that decline in new capacity that's been coming on stream. And this is one of the main reasons why mine supply has been struggling to rise in recent years. So cash costs rose in 2019. Costs were driven higher for a variety of reasons, which included declining production at various primary silver mines, which was boosting the per ounce cost of production, a decline in grades at various mines, and gains in silver prices during the second half of 2019 was another factor that came together to push up these cash operating costs during the year. So the production weighted cash cost rose for the first time in 6 years during 2019, reaching $7.10 an ounce, which is up from $5.47 an ounce in 2018. This chart shows us the margin between average annual silver prices and the production weighted annual average cash costs. The margin shrank slightly during 2019 to around $9 an ounce from a little over $10 an ounce in 2018, as costs rose at a faster pace than the price on an average basis. That said, these levels are still higher, these levels of margin are still higher than most levels prior to 2019. So this chart shows our supply-demand statistics side by side. And as can be seen in our expectations for 2020, we forecast a decline in both supply and fabrication demand. It's important, though, to notice that we expect fabrication demand to decline more strongly than supply, which is based on the expectation that consumers and businesses will be slow to spend when the lockdowns are lifted, while mines and scrap businesses will come back on stream relatively more quickly. There's a great deal of uncertainty with regards to the shape of the recovery after the lockdowns are lifted. What we've shown here is our base case, but there could be more positive or negative scenarios that play out. If, for example, there's a renewed increase in infections from the coronavirus when the lockdowns are lifted, we could be headed for a protracted period of economic contraction. And we can expect even deeper cuts to supply and demand than what are shown here. In this scenario, though, declines in fabrication demand are expected to far exceed declines in supply. A more positive scenario could be a rapid recovery boosted by the massive stimulus provided by central banks and governments. So that would mean a lesser decline in fabrication demand than what we're showing here. So it's hard to gauge which scenario will play out at this point. But the most likely scenario will fall somewhere between these two somewhat extreme cases. So neither do we expect a rapid increase in recovery, and neither do we expect a very protracted slowdown in economic growth. We don't expect, we think that there would be a gradual recovery in demand over the next few years. So with that ends our presentation. We will be launching our 2020 Platinum Group Metals Yearbook on the 30th of June. We hope you join us then. And with that, we can open it up to questions.
Thank you, Rohit. Yes, I forgot to mention at the very beginning that you can ask us questions by typing them in, and then we'll read them out and answer them. I apologize, I didn't mention that earlier, but on your dashboard, you should see a place where you can ask us questions. Looking at our supply-demand balance, you can see that the silver market is facing a number of headwinds in the short term and tailwinds in the longer term. I mean, in the longer term, we think that investment demand for physical metal will be increasing because we do think that the world is not going to get to be a much better place anytime quickly. In the short term, we have a drop off in fabrication demand. We have investors being somewhat cautious. So our view is that the price of silver probably moves slightly higher this year and a little bit more forcefully higher next year as an economic recovery does start to take root, followed by a period of higher prices later when investor physical demand picks up in response to those macroeconomic and political factors that we think will affect the market. If there are any questions, okay, we have our first question, which is, do you think investors will be skittish about getting back into equities and put money into commodities, including silver? Well, I think I just sort of addressed that. I think that investors will not be particularly skittish about getting back into equities. There will be some hesitance there, but our expectation is that as the economy picks up, that investors will resume their interest in equities. We're definitely seeing that over the last few weeks. The S&P and Dow Jones, I think, have recovered more than 50% of what they lost in March. And we think that that probably won't be there. That said, we do think that investors will continue to consider commodities, including silver and gold. The next question, gold prices, the gold price is increasing, but silver is not catching up with it. Therefore, let me just see whether silver prices will catch up with gold. Robert, you want to take that one?
Yeah, sure. We do expect silver prices to catch up with gold. We don't necessarily see that happening in the short term. We do think that in the medium to long term, you will see silver prices catch up to gold. We think you need a combination of a slight stabilization, at least in global economies, coupled with all of the liquidity that has been injected into the markets. Those two things as a combination will help to propel silver prices higher. So right now what you're seeing is you have the liquidity in the market, but you also have economic growth contracting, which is hurting fabrication demand. But once we see a stabilization in that decline and potentially a slow recovery from there, that plus the liquidity which we expect will remain in the market. We don't expect central banks or governments to pull that liquidity away from the market anytime soon. So that combination we think will really help to boost silver prices, and at that time you could potentially see silver prices heading up, maybe even stronger than gold, just because they haven't really risen much in recent times.
The next question is, we're in unconventional waters regarding all the money pumped into the system. And the last thing that the Fed wants to lose, in God we trust, i.e. central banks will not want to get gold and silver taking over their own fiat. Are there any means for government to control the price of precious metals in the short term? I'll take this one. The governments of the world and central banks of the world, by and large, are not concerned about gold and silver as replacing their fiat currencies. In our gold and silver yearbooks, we have tables that show percentage of private sector financial wealth that is in gold and silver, and it's less than 1% in gold, and it's even much less, probably less than 0.1% of private sector financial wealth in silver. Central banks for the last several decades have viewed gold and silver as relatively small asset classes compared to the currencies, and so they are not concerned. If you go back to the 1930s, when we were in the Great Depression, gold represented, our estimate is 33% of private sector financial wealth in the world. So gold was a much more important part of the global financial system and global monetary system. And it was into gold that a lot of money was poured in the early part of the Great Depression, taking money out of circulation. That's no longer the case. I mean, if investors decided to stock up on gold and silver, as they did in the period 2001 to 2011, they might take the portion of their financial wealth up to 1%. And that would have a tremendous effect in driving gold and silver prices up, but it would still leave 99% of the wealth in currency, national currency denominated assets. And of that, probably 70 to 80% is in the US dollar. So governments don't necessarily see gold and silver as a threat to their currencies. And they probably don't really care about that. They have a lot more important things to worry about. To the specific question is, are there any means for governments to control the prices of precious metals at the short term? Probably not, because precious metals are largely unregulated markets, and they probably are likely to remain that way, simply because they are relatively less important in terms of the overall area. The next question I'll let Rohit answer. It's photovoltaics. Has the use of silver been maximized? Substitution in the case of price sensitivity and the future prospects of photovoltaic markets, and therefore silver. Is there a linear relationship between prospects for photovoltaic market and silver use?
So with regards to thrifting of silver use in solar panels, we think that that is something that is expected to continue. There is still more potential for reducing the amount of silver that goes into solar panels. That said, we do think that the demand for solar panels in the future is going to rise strongly enough to offset any kind of declines in silver demand due to substitution or due to thrifting. We don't see substitution. It's mostly thrifting of silver use. So to answer the question about whether we think silver demand would rise in the future from solar panels, the answer is yes. We think it will rise, and the amount of silver going into each solar panel we think will decline, and that's the expectation in the medium to long term.
Okay, how do you see silver demand versus gold demand in India, Rohit?
So silver demand has been declining in India. The industrial side of it has been hurt, obviously by the whole coronavirus situation and the fact that India has also been on lockdown for several weeks now. The silver demand has been hurting from that, and its use in jewelry it's not likely to pick up anytime soon. So even when people do get out of the lockdowns, they aren't likely to go out there and start buying gold or silver jewelry immediately. So we think that silver demand would be depressed or hurt in India this year.
Okay. The next question is, with some of the major banks predicting gold could go to 2,000 or 3,000 an ounce, what are your projections for silver in 2020 and beyond? I'll answer this one. Let me just I'll start with an anecdote. In January of 2013, the price of gold was about 1580, having fallen from September 2011 down to 1580 in January. There was a major investment bank, actual commercial bank, that said in a report in January of 2013 that the price would probably break above $2,000 that year. Over the course of the first quarter, the price of gold fell down to about 1380, I guess, at which point that bank issued a statement saying that the gold price probably would fall toward $1,000 in 2020. We don't look at the bank's projections with too much concern. We look at our own. Now, our own view is that the gold price will rise somewhat modestly in 2020, but let's be honest, the gold price is already back to the record levels that we saw in 2011 and 2012. We call it the stealth bull market. The gold price has risen very sharply, and people in the gold market often complain, why isn't the gold price higher? Well, it's already at record levels. That said, our expectation, and it goes back to that economic chart that I showed you at the beginning, our expectation is that the gold price will rise sharply over the next 4 or 5 years and probably get to an annual average price above $2,000, possibly as high as $2,200 or so. That's an annual average price. The annual average price in 2012, the record was 1670. Our expectation is that the price will probably average about 1690 this year. So we're already at record prices in terms of annual average prices. But if you go back to that 1670 in 2012, the price peaked at $1,800 in 2011. So our expectation is the gold price will rise. As I said earlier at the beginning of our question period, our expectation is that the silver price also will rise somewhat modestly, probably around 1% this year on an annual average basis, that the price will probably continue to trade between $15 and $19 and spend most of the time around $16, $17 an ounce. In the longer run, by 2023, 2025, we think that you will see a period of time where silver prices spike higher. We're not sure that they will go to record levels, but in a spike, we do think that silver prices could go over $30. It will take a return of those long-term investors into the physical silver market to get the price higher and to keep the price higher. So that's we do think that silver will do that. I'll give you the next one, Rohit. In the US, I have talked to more people who want to install solar panels due to mistrust of local officials due to the mishandling of COVID. Could this materially increase demand for silver?
We do expect solar demand in the US to rise. We just see a bump in the road this year with factories being closed, with projects and installations being either delayed or suspended. So we do see a bump this year, but we do expect solar demand in the US as well as around the world to continue rising. So there also was a increase in demand in 2019 in California, which was related to the issue around the wildfires. So a lot of people opted to adopt solar panels as a way to be self-sufficient in that form. So we do definitely see demand for these panels growing, just not this year.
Yeah. I'll read the next question. I'm a little bit confused about it, and then I'll maybe editorialize what I think it is. Has the recycling ratio peaked at these prices? And what is an expected ratio if silver goes to either $10 or $30? I think what they're saying is recycling as a percentage of total supply. So I think the question, as I understand it, is has recycling peaked at these prices, and what happens if the price falls sharply or rises sharply? Ro, you want to take that?
I mean, if prices go up, you probably will see a increase. There's a fair amount of price sensitivity related to secondary supply, and at least from the scrap that's recovered from jewelry, you would probably see an influx of metal coming back into the market. On the lower end, I think the variability in scrap supply really comes mostly from the jewelry side. Electronics is relatively less price sensitive, so you will see a sort of a cushion or a floor to the amount of reduction in scrap supply. And there has been, because of government regulations, an increased focus on the amount of silver being recovered from these electronics. And there's an increased amount of electronics that are being properly discarded. So yeah, if you have higher prices, you will see increased amount of scrap supply. I don't know if I answered that question for you.
Okay. Do you expect to see growth in the silverware or healthcare space due to silver's antimicrobial nature? And would this be enough to impact demand?
We do see an increase in demand from those users. We do not see them this year, and they are not likely to be sufficient to offset declines in demand if they occur in any of the major uses like electronics, jewelry, solar panels. They're not big enough to offset weaknesses there.
Do you see any retracement in silver prices with coming deflation? Do you want to take that, or shall I?
I can let you take it first.
Okay, we do see a lot of deflationary pressures in the world economy. We're not sure that we'll see overt deflation. Yeah, we have suffered from disinflation really for much of the last decade. And actually some of the deflationary trends that contributed to the disinflation, i.e. low inflation despite all of the monetary creation, some of the trends that have caused the deflationary pressures that caused the disinflation over the last decade have been in place for really 20 years or longer, and they are accelerating going forward. So we do think that deflationary pressures will continue, and that they will be at least disinflationary and keep inflation from rising. We're not clear that we'll see overt deflation. Regardless of that, if you go back to the Great Depression, and if you go back to the period of the 1870s, 1880s, 1890s, when you had three massive bouts of deflation and depression, economic depression, you saw a lot of demand for silver. Now the 70s, 80s, and 90s, 1870s, 1880s, and 1890s are not really representative because you had a lot of other things going on economically. You had the opening of the West. Silver coins were the currency of choice in the United States, not necessarily US silver coins. Pieces of 8 from Mexico and Spain were often used as the currency of choice as settlers moved west. There was also silver coins were the currency of choice in China and a number of other countries too. So those days are not necessarily representative of what we could face today. That said, I think if you did see overt deflation, you would find a lot of people seeing gold and silver as a relatively less negative investment than assets denominated in national currencies. So I wouldn't necessarily see silver prices falling in a deflation. Rohit, do you want to add to that?
No, I think that covers it pretty well.
Yeah, and then the follow-on was even through LBMA and Comex, and the answer is no. I will say this, one of the things that we've seen over the last couple of years, and it accelerated in March, is there has been a lot of gold and silver sold by investors and other people, partly for liquidity, partly because they had bought the stuff on collateralized basis. There has been physical gold and silver that's been sold over the last couple of years, and it accelerated for a time in March due to the financial crisis. And that metal, when it's sold on a spot basis, and it often shows up in London. So you've seen LBMA stocks rise in recent years. You haven't seen anything for March because there's a long lag in reporting that data. So you have seen metal show up, physical metal show up in London. And a lot of people have talked about the spreads between London gold and silver spot prices for physical gold and silver in London versus futures prices in Comex. And the large spread represents the fact that the London spot physical market has a lot of metal in it, and the futures markets are futures markets. They're not necessarily spot, they are not spot physical. Next question. Why do you think investors, large and small, have increased their silver holdings in coins? We sell a 1 ounce coin, silver card. Demand is going through the roof. What is your explanation? You want to take that, Ro, or shall I?
No, sure, I can start this one.
Okay.
I mean, there's a combination of things going on here. One, you have silver prices that have softened a little bit from where they were earlier this year. They are at a fairly deep discount to what gold prices are, and like I said, there's an expectation that silver prices will catch up with gold in the medium to long term. So buying silver right now makes sense. And also fundamentally, you have a lot of, as Jeff mentioned in one of his slides, you've seen a movement of a lot of political and economic risks moving into a higher probability, higher impact zone, which further bodes well for silver investment demand as a safe haven asset. So there's a lot of these different factors that have come together right now, which is boosting demand. These are typically longer term investors, so they do tend to hold on to the metal for longer than some of the other investors in the market.
Okay. Why is silver not trending up in comparison to gold as the ratio is also widening? And in the short to medium term, where is the price of silver headed? You want to take that, Ro?
Yeah, I think this goes back to the previous answer, which was basically, the gold to silver ratio. We do think that silver is at a pretty deep discount right now. It has the discount has been widening primarily because you have this weakness on the fabrication demand side, and we do expect that the ratio will decline, and which will obviously favor silver once you see some stabilization in economic growth and the continued presence of this liquidity in the market.
Okay. Will silver prices cross $20 in the short term due to global recession?
we're not forecasting it to cross that in the short term. We do have it crossing those levels in the medium to long term. So in the short term, I think it might be weighed down by this whole weakness on the fabrication demand side.
Right. Okay, this one is not so much a question as a comment. I think it's a follow-up to something I said earlier. Governments can control and reduce investment and speculation in silver and gold prices by making ownership illegal in bullions or coins at the extreme, but more modestly having special taxation on precious metals, including and beyond transfer taxes, taxes at points of sales and purchases. It's all true. But it's probably not particularly meaningful. First off, as I said earlier, because gold and silver are such minuscule parts of the global financial system at this point, most governments really don't mind if people buy gold and silver. And some governments, for example, the Chinese government, encourage individuals to own gold and silver as a safe haven and portfolio and wealth diversifier. In terms of special taxation on precious metals, unfortunately, that already exists in many jurisdictions, including a lot of the states in the United States. So they're already doing that. But there's a thing that goes beyond that. And you see this in US Treasury policy over the years, and you see it in other countries to a lesser extent. And that's this. Governments don't necessarily want to impose restrictions on precious metals, because when they do, the commentary from people who believe in all kinds of weird conspiracy theories that are not supported by reality come out of the woodwork. And if you go back to the US Treasury in the 70s and 80s and 90s, up until the George W. Bush administration, the policy was, we don't respond to those comments because we just don't want to encourage that kind of discourse because it's meaningless to us. And I think that most governments in most parts of the world say, you know, if we tried to restrict or impose taxes that would reduce investment and speculation in silver and gold, first off, it wouldn't do us any good. Second thing, it probably is actually good for our citizens to have a diversified wealth. And third thing is it would raise all kinds of weird conspiracy theories and speculation that we just don't care to deal with. So while all of this stuff is, you know, there's an old joke about a guy who's in a hot air balloon and he's losing altitude and he comes to land in a field. And there's this guy walking down the country lane by the field, and he yells out to him, he says, "Where am I?" And he says, "You're in a gondola of a hot air balloon in the middle of a field." And the fellow's about to say something rude, and he says, "Wait a second, you're an economist, aren't you?" And he says, "Yes, how did you know?" He goes, "Because everything you said is true, but it's meaningless." And so I think everything that you say is true, but it's meaningless because governments just don't care to go there. I mean, you may be gold-centric and silver-centric. It may be the center of your career, but for government officials, it's not central. Are we supposed to be seeing slides? No. We are on that one slide. We're not jumping back and forth. Second question, can you discuss the effects of lower zinc and lead prices on silver production? Ro, you want to take that one?
Yeah, sure. So the lower zinc and lead prices, along with some of the other base metals as well as gold, that has been weighing on silver production, especially with regards to expansions at mine supply, as well as the bringing on stream of new mines. All of this has been constraining that new capacity. And so it has been having a negative impact on silver mine supply.
Okay. What materials are contributing to scrap silver recycling besides jewelry? What are the percentages, if we have them, contributing to scrap recovery, for example, of e-waste as a percentage of total scrap?
About a fifth of scrap supply comes from e-waste, and you have been seeing a increase in that percentage over the past several years as it's a combination of tighter government regulations with regards to e-waste. It's just a increase in the volume of electronics that are being scrapped. So both those together have definitely increased the amount of material coming uh, into the market.
Okay. Next question. How many ounces of silver do you think are above ground as all types of supply? Okay, when we talk about supply, we talk about supply of newly refined metal. Inventories and above ground stocks are somewhat different. Our estimate is that there's been about 57 billion ounces of silver mined throughout history. And the vast majority of that has been mined since 1900 with the advent of modern mining and all. Of that amount, there's about 3.5 billion that exists in coins and bullion, maybe 4 billion. So less than 10% is in refined metal form. There may be about 26 or 27 billion ounces in jewelry, decorative items, religious objects, and things like that. And that leaves about 28 billion ounces that were used in industrial applications. The availability of that metal is undetermined or lost. It may have been lost to mankind in scrap heaps and uses over the years, or it may be recoverable. We do know that there is an amorphous membrane between that metal that's held in industrial products and unrefined material and refined bullion, because we see that refiners will buy this stuff and use it, refine it, and use it directly, and it doesn't necessarily show up in our scrap data. And this is something that's gone on really, well, yeah, it's going on since the 50s at least, and probably even before that time. So it's hard to say, but in terms of refined bullion and coins that can come back to the market in almost immediate terms, you're talking about 3.5 billion. When you start talking about the stuff that could be scrapped and that has to be refined into refined bullion, you're talking about tens of billions of ounces. It seems that a lot of factors against the gold and silver. Demand from China and India dropped, especially in most important months. Industrial demand 25% down, and investment demand up 25%. It seems a lot of the media also coming up with stratospheric prices for precious metals. Moreover, the physical shortages claims are overstated. Do you see any pressures in precious metals for shorter term while stock markets continue to be afloat with Fed support? Moreover, U.S. strength will not be able to be challenged due to the swaps to allies' central banks. You want to talk about that, or shall I?
I'll let you take that.
Thank you. Yeah, okay. There are, as I said, there are a number of headwinds that the silver market is facing and the gold market is facing. You are seeing lower fabrication demand. You are seeing the investment demand is very cautious and is in some ways constrained by actual supply and distribution at this time. I do agree with you that the media, there's a lot of stuff. Gold and silver are amazing metals because they are unregulated. If I were talking about a company stock or an SEC regulated ETF or a debt security, I would have to make sure that I can tell you the truth and that I can support what I can say. I might be able to, in terms of stocks and bonds, you might say, well, this is my opinion, but this is the evidence upon which I based my opinion, so you can see it's a credible thing. Gold and silver don't have that. These are, as I said earlier, unregulated markets, and governments don't necessarily want to regulate them. And the free speech in the United States allows people to say whatever they want. And as a result, in gold and silver and in other commodities and on macroeconomic basis, you have a lot of people who don't know what they're talking about gold and silver and macroeconomics. I mean, I was watching a video this morning of somebody talking about central bank policy, and clearly he had no idea what he was talking about. Precious metals, I mean, one of the reasons I love precious metals is because they are totally unregulated. I love them, the unregulated nature, because it allows people to say such stupid things. And we've carved out our careers by having a superior flow of information and analysis. And by understanding what the gold and silver markets are really doing, when we see the markets move to excessive highs or lows based on unrealistic and inaccurate information, we know to expect a reflective move in the opposite direction. And our clients and CPM group can take advantage of that. So on the one hand, I love them because they're interesting markets. On the other hand, that lack of knowledge and the gruesome misrepresentation of gold and silver in the markets provides investment opportunities on a short-term basis. And I do think that that's there. There are outrageous comments about where gold prices are going and silver prices going that are just totally, I mean, if you know anything about mathematics and arithmetic, let alone economics and finance, you would say, God, this guy really doesn't know what he's talking about. And yet he's a highly respected precious metals analyst. And it's just it's a wonderful aspect of this market. Yeah, there are gruesome misoverstatements about, oh, there's no metal around. And as I said, you have record amounts of gold and silver in London. You have record amounts of gold and silver in Zurich, and you have record amounts of gold, I think, and silver too in New York now. You have enormous record amounts of gold and silver in the Chinese vaults too, held in banks, bank deposit accounts, and other assets. There's a tremendous amount of metal that's around there. It's not that there's a shortage of metal. It's that the people who own it don't want to sell it because of the uncertainties in the economy and the political world. And so that's what you're going to see there. But as Abraham Lincoln said, every person has his price. 2019, it was $50 silver and $1,800 gold. And at some point, you see people saying, I've made enough money and I'm going to sell my material. Berkshire Hathaway bought a tremendous amount of silver during the depressed period of time in the 1990s, and it paid less than $5 an ounce. It had a target, and it sold that gold, that silver at its target, which was around $9 or $10 an ounce. The price promptly went to $13, and Warren Buffett famously said, yeah, maybe I sold too early, but the key is I sold it. I got my objective. I made my money. He basically doubled his value in a few short years. And so I'm a happy camper, even though I probably could have said, let me diverge from my game plan and risk higher prices, see if I can get higher prices while risking lower prices. So yeah, it's a tremendous amount of misinformation in these markets. And God bless all those people who go around acting as if they're experts when they really don't know what they're talking about. It makes our jobs fun. All right. Is high grading a practice in the silver mining industry? If so, will it impact future supply, and to what degree? Bro, you want to take that?
Yeah, sure. So yeah, we have seen high grading, especially when prices for silver have weakened. It could weigh on silver demand in the future, but I think the bigger problem with the industry is just the lack of spending on exploration and expansions, which are needed to kind of keep the industry going. So I think that's the bigger issue with regards to future supply.
Okay. Do you see any risk in miners which are located in non-friendly U.S. allies with potential nationalization of the mines? Do you want to take that?
I can let you take that one.
Huh? I'm sorry? You want me to take it?
Yeah.
Okay. There's nationalization and then there's nationalization. And we have seen all sorts of government activities related to mining, increasing royalties, increasing taxes. Overt nationalization is relatively uncommon in this day and age. It was much more common in the 60s and 70s, and I guess maybe, yeah, I think by the 80s it was pretty much over. So what you find now is more of a national socialist impositions upon mining companies. You don't necessarily want to take over the mining company, but you want to tax it to an inch of its life. You know, if you take over and you nationalize a mine, you have to put up the capital. If you just increase the taxes, the mine owner has to put up the capital, but you can get a higher portion of the profits. And I think that most governments, not just allies, are unfriendly. U.S. countries that are unfriendly. Most governments are looking at that simply because they're all running massive structural deficits, and they're looking to see where they can raise money. Okay, the last comment, sorry, I had trouble understanding the analysis of the effect of the longer than anticipated COVID lockdown and the impact on demand and supply. What would the net effect be on silver supplies for the second half of 2020? You want to take this one, Rohit?
Yeah, sure. So we expect that silver demand would recover a lot more slowly than silver supply. At this time, you have both of them turned off. But when the lockdowns start getting lifted, I think that silver supply in terms of both mine supply as well as scrap supply will come back on stream. They will come back on stream relatively quicker than what we think will happen with fabrication demand, primarily because we don't see businesses or consumers going out there and aggressively buying silver goods fabricated using silver, at least for some time. I think we'll see a certain amount of caution exercised as part of the business, or at least months before we start seeing an uptick in demand. Net effect would be basically now be an excess of supply over fabrication.
Okay, that concludes the questions, and we've gone on for almost 90 minutes here. You will see on your screen that our next yearbook will be the Platinum Group Metals Yearbook, and we will release that on June 30th with another webinar. We hope that you enjoyed this presentation and it was useful and informative. We hope that you go online and buy our silver yearbook as well as our gold yearbook and pre-order the platinum yearbook at cpmgroup.com. We also have monthly reports and a variety of other services that we provide. As it says at the bottom of the screen, for general inquiries as to what we can do for you, send an email to info@cpmgroup.com. In the meantime, don't drink any bleach or industrial detergents and keep washing your hands. And we hope to see you all back when we're here in June for Platinum Group Metals. Thank you.